Most people think banks just store the money we deposit, but in reality, banks create money every single day. Let me show you how. When you deposit $1,000 into your bank, that money doesn't just sit in a vault. The bank is legally allowed to lend out most of it, usually around 90%. So, if you deposit $1,000, the bank might lend $900 of it to someone else for a car, a credit card, or a small business. Here's where it gets wild. That $900 loan doesn't come from thin air exactly, but once it's spent, it becomes someone else's deposit in another bank account. And that new bank can now lend out 90% of that $900 again, another $810, and so on. It's called the fractional reserve system, and it's how money multiplies through the economy. From one original $1,000 deposit, the banking system can effectively create around $9,000 of new money in circulation through lending. And here's the twist. Most of this money exists only as numbers on screens, not as printed cash. The Federal Reserve sets the rules, controlling interest rates and how much banks must keep on hand. When the Fed lowers reserve requirements or buys government bonds, it gives banks even more capacity to create loans, and therefore, money. That's why central bank policy affects inflation, asset prices, and the entire economy. So, the next time you swipe your card or take out a loan, remember, banks don't just move money around, they literally manufacture it every day out of debt and confidence. That's how modern money is born.